This is our Forex blog for January 26th, 2011. One of the first things we do is watch the currency meter and find the pairs that are strong and buy those versus the pairs that are weak. Here we have a weak dollar a couple hours before midnight, and the weekly monthly trend's down, which means you're trading the real-time trend in the direction of the longer-term weekly and monthly trend, and then you just simply want to find one of the stronger ones. You can see the Euro has a very strong weekly and monthly trend, so does the Swiss. The New Zealand's a little bit less strong. Let's scroll this back and see what it looked like right before midnight. So you can see a little bit, a couple hours before midnight, you start to have some strength in this one, a weakness in the dollar. So you want to buy the strong Euro versus a weak dollar. Let's see about the Swiss. It didn't really have the strength there, so you probably wouldn't. You don't want to buy two currencies that have either slight weakness or, don't buy one red versus red. Now the weekly monthly trend, we're up on this, so you certainly might be able to find some 5 to 15 pip moves, but you're not likely to find bigger pip moves. Let's look at the New Zealand here. Before midnight, this one, a couple hours before midnight, had some strength, and it continued for many hours. The weekly monthly trend were just slightly up, so it just probably shifted up yesterday at some point. So basically we want, right before midnight, to focus on buys in the euro dollar and the New Zealand dollar. And if you had incredible strength in the pound, it would be okay too, but it really didn't have that much strength, and the weekly trend was down. So you're always better off odds wise, percentage of winning trades wise, focusing on the weekly trends. So here's the euro dollar. You can see a couple hours before midnight we had this little pullback. By the way, this is our Elliott two-wave pullback in action right here. Anytime it comes down to that level, I might have gone into this trade right here at 71 with a few pips stop underneath here. If you did get stopped out of that by having too tight a stop, you would have lost a few pips, 5 to 8. And then when this thing started to go back up again, you get back in it here around 70, and it worked its way up to the previous swing high up here at 01. So you had the potential of making 30 pips on that trade. You might have lost 5 or 6 on the first one, or if you had a little bit wider stop underneath the 1.618, that's typically where I put my stop. Usually when you have a decent sized fib move of 25, 30, or 40 pips, the bigger and the more pips, the farther away the fib targets are, and the more likely they are to hold. Never use a fib on a 10 or 15 pip move, 20, 25 minimum, and I prefer 30. In this case, we have the high up here at 04. The pullback down here is at around 78. So this barely meets our criteria, and because of that, it's more likely to go through the first one and possibly find some support here at the second one. You could also use a tick chart to get into this trade, and you might have got in and maybe got out at break even because it did go up 5 pips, enough to move your stop up a little bit. Maybe you got stopped out and lost 5 pips, got back in again and made, even if you only made 20 on here, you lose 5, make 15, or I'm sorry, you lose 5, make 20, you've net 15 pips. Super strong currencies, when they are trending one way, usually the first time they come down and touch the hourly, it's pretty high probability place to buy. This is one of the systems that we teach in class. If that area holds and then starts to go back up, if you're a really aggressive trader, you might go long somewhere around here. If you're a little bit more conservative, you might wait for the high of this previous bar. The bar that touches the hourly, the high of that bar, as long as it's not 10, 20, no more than 10 or 15 pips max up from the hourly. If it's 25 pips up, you want to get into that trade a little earlier. And then on the way up, the previous month's high looks like a great place to get out of the trade because there's not a whole lot of statistical momentum at the time. Now let's look at the other one that was strong, the New Zealand. And you can see something kind of similar, although in this case this is only about a 10 pip drop, so you can't draw your fibs on there. It did pull back past the 10-day moving average, found support at the 20, and look at the strength there on the way up versus the way down. It was extremely strong. The New Zealand's pretty much going up against everything towards the end of the US close yesterday, and then on the way down the New Zealand wasn't that weak, and this is telling you that the dollar wasn't that strong. It's above the hourly. It found perfect support here to 20-day, and whether you wanted to wait and see it go back above the 10-day moving average, that's fine, but you get into this trade here, You may or may not have got out of the trade. It's up to you, how you handle 2-hour sideways consolidations. Usually myself, I get out of them and look to get back in again. It comes down, finds support this time, you get back in it again here, and then it's just working its way up to a lot of resistance up here. Weekly pivot, previous week's high, monthly pivot level, previous day's high. There's so much resistance right there. With this kind of momentum on the way up, it's not very likely to go through it. So you exit your trade with maybe 15 to 20 pips. And again, because this was so strong, you're looking to buy the hourly right here. There wasn't a whole lot of weakness, and then in this case, unlike the dollar or the euro dollar example, it didn't work. You got into the trade and it kind of went up a few pips. Didn't really fall like a rock as soon as you got in. It went sideways for an hour and a half. And this is many of the reasons why I tend to get out of trades. I use something called a time stop. If I'm in a trade for 20-30 minutes and I see nothing going in my way. Look, we got in this trade here. It had a little bit of weakness. There's no strength whatsoever. So it's going sideways. Price is telling me it's not going my way. And our statistical tools are also right here on the bottom telling me that it's not likely to go up. So why would I hold on to this? If I can get out of the trade with 2 or 3 pips profit or lose 2 or 3 pips, I'll get out. I wouldn't want to sell here because the weekly and monthly trend's up and we have a support level here and we have a support level here. So, you're trading against the longer term trend if you were to sell a breakdown of the hourly. Usually if a currency's longer term trend's down and it comes down to the hourly and can't go up, I'll sell a breakdown here. But in this case, the weekly trend's up, the monthly trend's up, and we have support here and we have support here. This doesn't pass mustard for one reason. You don't want to take a trade, especially going against a longer term trend, if the reward isn't big enough. Now, I sometimes break my rules in selling currencies when they break the hourly, if the weekly and monthly trend are up, but I'll only do that if I have a potential of 20, 25, 30, 50 pips. If these weren't here and the next support level is all the way down here, I would have taken that shot. And whether it worked or not, we don't know, but at least if you're going to take a risk or one trade that's higher, or I should say a higher risk, lower probability, it's 50-50 at best, at least have the reward upside. Now later today, the pound became really strong. Unfortunately, the weekly trend's down in this. But you could look for whatever currency's weakest at 4 o'clock and look for buys in the pound. What is the weakest at 4 o'clock? Well, this is weak, but it was also weak for a couple hours. If a currency's already been weak for 3 to 4 hours, in my opinion, from my experience, it's less likely to continue it. I want to see a currency that had mild strength before and then all of a sudden became super weak right at 4 o'clock. Then it has a much greater distance to go. Just like this one. This one had a little bit of weakness here, and then the strength came in. So in this case, the New Zealand was strong, and then we all saw in the New Zealand dollar it really just didn't want to go anywhere, and it had a little bit of weakness right there, and it's pretty consistently weak. The dollar, you could have also looked for dollar pairs because it was extremely weak too. So let's look at the pound dollar. Even though if the pound has incredible strength like this and the dollar has slight strength, because the weekly and monthly trend's down, you can break our rule of not buying 2 green ones against each other. The pound dollar is still likely to give you 20-30 pips here because of the intensity here and the weekly and monthly trends weaken the dollar. Let's bring up the pound dollar pair, and we'll go over this one. And so you can see here at 4 o'clock, it had gone down underneath the hourly without that much weakness, came back up to this fib level, which usually when a fib level breaks, it acts as resistance, and so there it breaks above it. And you can see you have a breakout above the hourly. You have a little pullback right here where it didn't go back underneath this fib or the hourly. Great place to get in. And I was wrong. It didn't just go up 20-30 pips. It went up more than that. It went up from 20 all the way up to about 70. It's a 50 pip move there. And note, it didn't have that much intensity, so when it hit the weekly pivot level right here in our upper containment bands, which usually contain price, as you can see, contain the price here and here, you want to buy the next pullback. And I would have preferred more of a shallow pullback, maybe to 58.40 right here. This one came all the way back down to that level, but this stayed green the whole time. So what that's telling you is the pound's getting weaker against the dollar, but against other pairs it's not getting weak. The dollar is getting stronger than the pound right here, but against other pairs it's not strong. This is green the whole time. Anytime you see a pullback with green down here the whole time, it's usually, my experience, well over 65% of the time to go up. and I might have went right long right here when this turned green and broke out of the previous bar, and it just shot up here. And now we have extreme strength, so this trend's likely to continue. I would have got out of the trade probably up here at the upper band, bought this little pullback. That trade didn't work, but we could have probably made 5 pips there. And you have, it looks like an Elliott two-wave pullback right here. It didn't quite hit that level, so I might have bought this right here as it starts to go back up. And here at 65, it went up about 12 pips, which is more than enough to move your stop to break even, according to our rules. And then it pulled back down again. Again, look at this. No weakness on pullbacks. Didn't go below that low. You go long again right here, and this time it went up about 30 pips. And again, it didn't have that much momentum, and so we have a counter trend sell signal right here, right at our upper band. Take your 20 or 30 pips and be happy. With the currency meter, it really found this incredible strength here, even earlier than the 4 o'clock. But you might have missed the first move. You bought the pullback, you made money. You bought the pullback after that, made money. You probably got into one trade where you broke even, and then you basically caught another 20 or 30 pip move. Now, sometimes currencies do not, I repeat, they do not go one way forever. A currency that's weekly and monthly trends down, and it's been going down against most currencies for 3, 4, 5, 6 days, it's bound to have a pullback counter trend day. So if you see a pair like that with incredible strength, like this one right here, the CAD at 1, very strong. The dollar was very weak at the time. I would prefer, in a perfect world, we don't trade one currency that has a weekly and monthly trend down versus another. But sometimes the best opportunity in real time, you're not maybe likely to get 30 and 50 pip moves, but you can catch 5, 10, 15 pip moves all day long most of the time. So you look for sells in the weak dollar versus strong CAD going into about 1 o'clock and afterwards. Now we want to look at the support resistance. I'm going to bring this up right now. If there's any kind of support resistance at that time, here's the 1 o'clock. It went sideways right here. You might have went short right here, and it only pulled back about 5 or 6 pips. Notice no weakness at the time because they were both, if one of them's slightly weak and the other one's slightly more weak, you're not going to get any kind of explosive move. But you might have lost 5 pips there. Came back up and tested the hourly right here. You can see it's kind of underneath our fib level. Great place to go short. You waited probably an hour for that pullback, and then the trend continued. And notice also not a whole lot of momentum. So when it hits the lower containment band, which also happens to have the 20-day moving average and the weekly pivot, major support areas where there's likely to be buying. Without this kind of extreme momentum at the dotted white line, it's not likely to go through there, so you exit. And whether you got into the trade right here, probably where I would have, a few, 8 pips off the high maybe. I don't want to, I almost never get into a trade more than 10 or 15 pips after it started moving. I want to get in as early as possible. I'd rather get in, take a 5 or 6 pip loss, get in again, take a 5 or 6 pip loss, get in the third time and catch the move, than miss the move. Because it's when you find these high probability trades, you got to be in them, and or you're not going to profit if the trade works. And most of the time, if you pay down after it's already moved down 10, 15 pips, it might move 5 or 10 more and then reverse on you, and you get stopped out. The earlier you get in, the bigger the potential of the profit, especially in the middle of the range like this. You get in at the middle of the range, most of the time your profit's the lower containment bands if the trade works. Not all the times do the trades work. As you can see right here, it didn't pull back. In fact, a better trade was when this was above the hourly and broke down underneath it. It had this monthly pivot level right here. It's going sideways for hours. This was the ideal entry because it was in a very sideways range. It broke underneath the hourly. There's major support here, so you don't want to sell right here because it's likely to find support here. But once the support breaks, the next profit target's down here, 15, 18 pips away. You risk 7 pips to make 18. It's a good trade. Now, after that drop here, you might have looked to sell the next pullback up, and you can see it pull back about 5 or 10 pips, more than enough to move your stop down, or maybe you lost 4 pips on that trade, and you can see it's just not extremely weak anymore. The dollar's weakness disappeared for the second half of the day. In this one, later in the day, had brief amount of strength, but they were both strong at the same time. You would have been better off trading the CAD against the weak New Zealand. All right, let's look at this. You sell the weak New Zealand against the strong CAD, and look at this chart. and it didn't really actually pan out. But every single pullback up went down, pullback up went down. Unfortunately, this one wasn't off the charts explosive. Let's compare the CAD to the Australian, which was also weak. Hopefully, this one. Yeah, not very explosive moves, but again, once the currency broke underneath the hourly right here, if you sold every time, it did go your way. Most of the time where you trade some of these cross pairs that we don't normally trade on a day-to-day basis, we find 30, 50, sometimes 100 pip moves, but not today. It's just not one of those days, unfortunately.